Okay, so 6.1 is the direct write-off method of recording uncollectible accounts. We have one learning objective. You need to be able to calculate and record uncollectible accounts expense using the direct write-off method. First, they're going to go through some terms for our chapter. Uncollectible accounts are accounts receivable that cannot be collected. Uncollectible accounts are sometimes referred to as bad debts. Writing off an account is canceling the balance of a customer account because the customer does not pay. So really what it does is we write that off to zero so that we don't have that lingering account when we know we're not going to get paid for it. Recording uncollectible accounts expense only when an amount is actually known to be uncollectible is called the direct write-off method. So this means that we actually know that we aren't getting money, and that's when we write off the account. That's called then the direct write-off method. Okay, so first example, on November 4th, it says that we wrote off Plaza Electronics account as uncollectible, $182, memorandum number 62. So we've done this before. We're going to put this into our general journal. We're going to debit our uncollectible accounts expense, and we're going to credit accounts receivable Plaza Electronics for that 182. They are showing us our T accounts over here, so we can see what this looks like. So right now, the balance in accounts receivable is at that $1,648.95, but we're going to decrease it by 182. We see Plaza Electronics owed us $182. However, we're going to write off their account, so we're crediting in their account for 182. So now their balance is going to be a zero balance. Okay, collecting a written off account direct write-off method. So in this instance, what happens, we've seen this before, is we might write off the account and for some reason they end up actually paying us. So now what we need to do is we need to reopen their account and then pay it off. So there's actually two things that we're going to be doing. So number one, it shows us here, we're going to record an entry in the general journal to debit accounts receivable, Plaza Electronics, and credit uncollectible accounts expense for the amount of the receipt of 182. So I'm going to go back a slide. Really all we're doing is the opposite. So here, when we closed that account, when we wrote off that account, we debited the expense and then credited the receivable account. Here we're going to switch that back. We're going to debit our accounts receivable, Plaza Electronics, so we're going to credit uncollectible accounts expense. The second part to that is we need to record the cash amount. So we're going to record an entry in the cash receipts journal to debit cash and credit accounts receivable for the amount of that receipt. So here we're showing that Plaza Electronics paid us $182. All right, number one, why should the amount of an uncollectible account be removed from the assets of a business? When a customer's account is believed to be uncollectible, it should be written off because it is no longer an asset of the business. We don't want to leave that out there as we're supposed to be receiving that money when we know we're not going to be receiving it. Number two, in the direct write-off method, how is an uncollectible account closed? We're going to debit uncollectible accounts expense, and we're going to credit accounts receivable. Also, that specific customer account in the accounts receivable ledger will be credited. And last question, number three, why is the customer account reopened when cash is received from an account that's previously written off as uncollectible? The account needs to be reopened to provide a complete history of the customer's credit activities. If we were to leave it as closed, it looks like that customer does not owe us any more money when they actually pay us. So we need to make sure that we reopen it so it shows that they owe us money and then pay it off. Okay, that was the end of the lecture. You can now go to your 6.1 work together video.